Today's video is not a strategy-related video. This is going to be an informational video in which we will understand liquidity. Liquidity is a very important concept in trading. Many beginners who trade don't know about liquidity, which sometimes gets them into big trouble. We will understand what is the importance of liquidity in trading. We will learn why the chart of some companies moves very fluently and why the chart of some companies looks like long lines. What kind of stocks should we trade in? Let's first understand what liquidity is. Suppose you have a property in Mumbai City. Now, if you want to sell this property, would it be easy or difficult to sell a property in Mumbai? So the answer is very simple. In a city like Mumbai, where there's a huge demand in real estate, selling any decent property is not a difficult task. Now, that was about Mumbai, but suppose you have a property in some rural village area. Now, you tell me, will selling this property be easy? Look, the property will eventually get sold, but compared to the Mumbai property, it will be a little harder to sell because for a Mumbai property, you will easily find a lot of buyers. But for the village property, finding a buyer will be a little difficult. If we say it in simple terms, how easily you can buy or sell any investment, that's called the liquidity of that investment. Based on the example we just saw, we can say that the liquidity of the Mumbai property is high and the liquidity of the village property is low. Now see, every asset class has different liquidity. Cash is always king, meaning cash has the highest liquidity. After that comes gold, because we all know that we can very easily buy and sell gold. Then comes stocks, which have slightly lower liquidity than gold. Then comes property, and the asset class with the least liquidity is modern arts. Now you tell me, what would be easier? Selling the gold lying in your home to a jeweler or selling a piece of modern art lying in your home to someone? It's simple, selling gold. So we've now seen the liquidity of different asset classes. Now let's talk about the importance of liquidity. So far we have seen that when liquidity is high, it becomes easier to buy and sell investments. And secondly, because of liquidity, you can buy or sell an asset at a fair price. And thirdly, if you want to sell an investment and it has high liquidity, then there is less stress in finding a buyer. For example, take gold and modern art. If you have gold, you won't be too stressed selling it. But if you have a modern art piece, it might be a bit of a problem to sell it. And the most important thing is when you need cash, you can easily convert high liquidity investments into cash, whereas you can't quickly convert low liquidity investments into cash. So now let's talk about liquidity in the stock market. Stocks that have a lot of buyers and sellers are called high liquidity stocks. And those stocks where fewer buyers and sellers are interested are called low liquidity or illiquid stocks. Now, one question arises, how can we find out the liquidity of stocks? Now see, this is very surprising. Liquidity is such an important concept, but there's no official measurement that lets us know whether a stock's liquidity is high or low just by looking at it. For this, we need some practical knowledge and experience. So let's now look at how we can find out a stock's liquidity. The first way to find out liquidity is by looking at the stock's market capitalization. Market capitalization means the total market value of a company. This basically tells you how big the company is. For example, a small bank like Insolbank has lower liquidity compared to large cap stocks. Now let's talk about small cap companies. These have very low liquidity. Now see, even within small cap companies, there's a subcategory called micro cap stocks. And these stocks have the lowest liquidity. And new investors or traders get trapped in these stocks. When the market is going up, these microcap stocks rise very fast, and investors also invest heavily in them, hoping for multi-baggers. And it's not like no one makes money in them. Many people do. But when the market starts to fall, there are no buyers in these stocks. The liquidity drops drastically, which causes these stocks to fall very rapidly. And since there are no buyers, people can't take their money out. They just watch their capital getting destroyed daily, but can't do anything because there's no one to buy. For example, in 2017, microcap stocks rallied very well. But when the 2018 correction came, these stocks dropped 50 to 60% and sometimes even 80%. This only happened because there were no buyers in the stocks. In comparison, large cap stocks only saw a correction of 20 to 30%. That's why smart people say, stay away from microcap stocks. And even if you want to invest in them, do it through mutual funds, which are much safer. The second way to check a stock's liquidity is by looking at the spread. Spread means the difference between the bid and ask price. That is, at what price the buyers are ready to buy and at what price the sellers are ready to sell. The difference between these two is called the spread. High liquidity stocks have very small spreads, and low liquidity stocks have very large spreads. As you can see in these two stocks, the high liquidity stock has a very small spread, and the low liquidity stock has a very large spread. And you can see this spread in any trading terminal. And the third and quite easy way to check liquidity is by looking at the intraday chart of stocks. Stocks with high liquidity have charts that flow like water, meaning you won't see any price breaks. As you're seeing now, they mostly run based on news or are operated by operators, where price action doesn't work properly. So that's all for today's session. Hope you liked the video. See you in the next one.